You're watching Famous Dave on YouTube.
Hey, what's going on, folks? I just wanted to come on. I just put a position on in UVXY, and I just kind of wanted to come on and discuss kind of what I'm thinking about here with you and see what you think. Okay, so let's go to the position here behind me. I'll get out of the way for a second. And what I did was I sold a few options about a week out, and then I sold one option 2 weeks out. So if here's UVXY here, if we go to the chart, or this is in Thinkorswim here, at the bottom of the screen you can see my position. I'm short in 2 weeks expiration from now, or 15 days. I'm short one of the 80 calls. Okay, UVXY is 36 right now. So I sold one of the 80 calls this morning at $1. They've gone down. Now they're 76 bid at 86 cents. Then besides that, I sold some of these 47 level calls that expire in 7 days. Excuse me, at $2.47 and $2.48. And then when it came down a little bit, I sold one of these puts, the 34.5 puts. I sold one at $3 and I sold one at $4.45. So here are all my trades up here. So if you want to look at those, you can also see my somewhat abysmal P&L so far this year. Anyway, so I want to talk to you about this position and, you know, what kind of risk level do we have? Is this appropriate? What am I looking for? What am I looking to gain here? What's the risk, etc.? Well, if you look up on the left here, you can see it shows option buying power. It says net liquidity $12,800, option buying power $4,100. So what that means is that of $12,000, I have $4,000 left that's like not allocated right now that you could do stuff with. It's kind of what that shows you there. And if we go down to the bottom of the screen here, and we see this here, this part here, the top row where it says UVXY, that top line is going to show your kind of totals and show it. So it shows short 12 deltas, theta's 130. That means I'm collecting $130 a day from this position. Then if we move over here, it shows P&L open. That's how much the position's made since it was put on. P&L day, which is the same because I put the position on today. And then this here BP effect, that's telling how much money I have to have on account to cover this position. So every options trade I did here has been a sale, right? So I've collected more money than my account had before because I've sold these options. However, I've also put on some risk. So if we go back up to the left side of the screen here, you see this number 1388 whatever. Well, you'll notice that that is the difference between the net liquidity number of 12.8 and this cash sweep vehicle number of 13.8. That is about $1,000, right? And that's how much premium I've sold. So if we expire right now and everything expires worthless, my account would go up by $1,000. Essentially, is what that kind of shows us there in this case. Now, let's go and look. When we were looking at our risk, what we want to consider is what happens to us if UVXY moves X amount, right? So this is a position where we essentially sold strangles, which means we sold calls to the upside and puts to the downside. So this would work out perfectly for us if UVXY just stays here, or even if it stays between the strikes that we sold, which are to the downside is the 34.5 strike is the next strike. To the upside is the 47 strike. And so, but we want to see what our risk is. Now this buying power here that says negative 9,000 here on the right that I'm pointing to, that is how much I'm required to let the brokerage hold to protect against my risk. So if the worst case happens, they already have that many dollars of mine so that they're kind of protected against the risk. However, this number is going to move around depending on the price of UVXY. So we need to kind of figure out how much this number is going to move around and what that's doing to our buying power and where our risk is. And the way I do that here is I go to the Analyze tab, and I pull up the Analyze tab, and once again, I'm going to get out of the way here so you can see a little bit better. And maybe we can even just blow this up a little bit, possibly. So let's try to do that. All right, so here we have the Analyze tab, and this is price slices under the Analyze tab. And you can see here there's 3 lines. It says 73, 36, and 32. Now, I have this on kind of a custom setting right now. Generally, what you're going to get is prices for a 10% move up or down, and then the middle line is going to be the price that things are at right now. However, I've adjusted it so to the upside, I can see what happens if we move up 100%, right? Because that's kind of what I'm fearful of, is that we get a spike upward. I'm not so concerned with a spike downward. It's more likely if something is going to spike, it's going to spike upward in the VIX. So, but let's reset this to kind of like factory settings here. So if I go to the right here and I click, I can hit reset slices. Okay, so now it's just 10% up, 10% down. And as we go across the screen here, we've got delta. All right, so delta has many definitions, but one definition is how many dollars you will make or lose for a 1-point move in the underlying. So this middle number here where we are now, and short 19 deltas, means that if this goes up $1, we'll lose $19. If this goes down $1, we will make $19. Doesn't sound like a lot of risk, right? You know, $19 either way. It goes up $1, 19, you lose 19, down $1, you make 19. However, you can see if we were to go up 10%, all right, now this number is 70, right? It jumps from 19 to 70 as we move up 10%. Well, why is that happening? What does that mean? And then if we go down 10%, down 10%, it's actually, I'm actually now long 35 as opposed to short. Well, how is this number moving around? What is the rate at which this number is changing? Well, we can go to the next, surprise, we can go to the next line over here, and gamma is going to show the rate of change for your delta. So if you're short 14 gammas, short 14 gamma, that means that for a $1 move, your delta will change by 14 deltas. And since it's a short number, it means it's going to change going against you. So if we move up $1, moving against us would be for your delta to get shorter, right? Because that way you're making less money as it moves up. So short 14 gamma means if UVXY moves up $1, this delta is going to change by 14. So instead of being short 17, we would be short 17 minus 14, which is basically short 3 deltas. So the first $1 up, we would go from short 17 deltas to short 3. The second $1 up, we would go from short 3 deltas to long 11, and so on and so forth. So that's kind of what gamma means. Okay, theta here. Theta tells how much your position is either costing you or paying you per day. Remember, all options have an expiration date, and as we get closer to the expiration date, options decline in value. And another way of thinking about that is, as we get closer to the expiration of these options, the less likely it is that we're going to move through that strike that's far away from the stock right now. So as we, if we were 10 minutes till expiration, then it would be very unlikely that these, sometimes, to think about these things, think about them in extremes for you to understand them. So 47 call, then I'm short. Right now it's this UVXY is 36.29. So 47 call, $10 away. If we had 10 minutes till expiration, nobody would be paying you $1.76 for these calls, right? Because it would be very unlikely that that could happen. However, with 7 days till expiration, well, you've got a fighting chance that this actually could happen. How likely is it that UVXY could go to 47? Well, I can tell you. All we have to do is look at the delta of the individual options. So I'm going to go in and I'm going to change my screen here to delta, and if I move it over, just so you can take a quick look, the delta of this 47 call is 28. So there's a 28% chance that according to all the pricing and everybody who's trading UVXY options has contributed to the price of options now. And according to everybody's cumulative pricing, there's a 28% chance that UVXY is over 47 on expiration in 7 days. So that's the delta, and that's what that means. All right, so let's go back to our little price slice here. So, all right, so theta, collecting 127 a day. Okay, well, that's true for today, but what about tomorrow? Well, first of all, let's check and see what date that this model is set on. All right, it's set on yesterday's date, so let's fix that first of all. So actually, we're collecting 130 a day in theta. But if we want to see how this is going to change over time, we can start moving the date forward, right? So I'm going to go down here to the date, and I'm going to click forward a day. And as we get closer to expiration, it's going to decay faster. That's expected. And you see as I click the date, 7/1 now, 7/2. Once I get past expiration, the decay drops to 0 because it's over for that option. But the day before expiration, stuff is decaying. It went down a little bit, and that's going to have to do with out of the money versus at the money type options. But you can see that as this, over time, this is going up as we get closer to expiration. You can also see that the gamma is changing slightly. It's going up slightly, and the deltas change as well. So, when you look at price slice and you see your Greeks, well, that's all well and good what it's telling you, but you want to kind of mess with the date a little bit to see how it's changing over time, because your deltas might be changing drastically between today and tomorrow, and you'd rather know probably what's going to happen tomorrow than today even, right? Because we'll be at tomorrow pretty quick. Okay, so then as we move across here, Vega. Okay, Vega is pretty small with these options because we're dealing with stuff that's expiring very soon. However, if we were trading options that are farther out in time, this Vega number would be more significant. But Vega is the change in your P&L for a 1-point move in volatility. So right now, if you look to the side here, these options are trading at 205 vol. If vol were to come in 5 points, then we would make $50, right? Because we're short 10 Vega. So 10 times 5 would be 50. So this is how your position is going to be affected by a 1-point move in volatility. P&L, that's just how much the position is made. Now let's go to BP effect here. This is one thing that I really wanted to emphasize, and one of the reasons I came on today. So, all right, so we see it's costing us $9,000 to carry this position. However, up 10%, all of a sudden it's costing $11,000, right? So if we went back to our little screen here, and I have to pull it around again. If we went back to our little screen here, okay, right now we have 4,000 in buying power. However, if we were to go up 10%, this buying power effect number goes up by about $1,500. So subtract $1,500 from that. So up 10%, we only have $2,500 free money, reserve money. What happens if it goes up 20%? All right, so if it goes up 20%, is that 20%? If it goes up 20%, buying power goes to 13,850, right? That's going to tap us out. We're going to get a call. If UVXY closes up 20%, we're going to get a call the next day saying you need to deposit more money in your account or cover your position because you don't have enough buying power. Now, as it is, this up 20% number, which is, it says buying power 13,859, that's right around exactly how much our account could manage. So we'd be okay exactly up 20%. However, up 21%, and all of a sudden we're getting a tap on the shoulder, and the broker just calling and saying, like, you don't have enough money in your account to cover the position. You need to either deposit more money or cover your position. So what does that mean? Well, to me, that means that we've probably got too much risk on, right? Because if stuff goes up 20%, all of a sudden we're in trouble, and we've got too much risk on, and we have to deposit more money or take stuff off, right? So this is a pretty risky position we have on right now as far as risk management. Now, the good news in all this is, well, if we go back and we look at our Greeks here, I'll pull them up beside me here, we can see that up 20%, well, yeah, we don't have enough buying power, but we haven't lost a ton of money, right? Up 20% here, it shows losing $340. Now, while nobody wants to lose $340, as a percentage of the account, $12,800, that's not a lot to lose. And this is kind of the advantage of having tight margin requirements with VIX products, is that it forces you to be rather conservative with your trading, because of the fact that they require me to put up so much money to have these positions on. That makes it so I keep my positions smaller. But even that said, this number really isn't acceptable to me. Like I said, I like to look and see what would happen if this went up 100% in one day, because it's perfectly possible that that could happen, right? So let's set this number at, well, let's start and set it up 70%. What if UVXY went up 70% in one day? Well, let's take a look. Okay, so up there, I would be short 260 deltas. Up 70% would be if UVXY went to 61.90 today, almost 62. So up there, I'd be short 266 deltas, which all things being equal, I probably would want to be short those deltas up there, because usually in a spike, it comes right back down. But the real question, how much would I lose? Well, I would lose almost $4,000 if this went up 60%. Now, that seems like, to me, it almost seems like an appropriate level of risk, because, yeah, to collect $150 a day in decay, or $130 in decay, you have to be taking some risk, right? And that's the risk I'm taking, is that if this goes up to 61 and stays there, I'm going to lose $4,000 out of my $12,000, But that being said, it's not like it would bankrupt me, right? I still would be in business. I'd be down $4,000. However, the other thing that this shows is my buying power would be way above my account. So they would want me to either cover my position somehow or put more money in the account. In fact, they would want me to put like another $12,000 in the account, or more than that, actually, right? Another $16,000 in the account to cover my position. Now, I could certainly find a way to craft my positions. If we were to gap up there tomorrow, I could find a way to reset up my position so that I was still short that 260 deltas, but I was not under a margin call, which is what this would be. However, to me, it doesn't seem like that's huge risk, that if this goes up 70%, I lose $4,000. That seems like that's an acceptable amount of risk for me. Well, let's see if it goes up 100%. Now, remember, this would be 100% without being able to adjust or do anything. All right, so up 100%, I lose $7,000. So that's pretty significant, right? And look, the buying power. Now I would have to deposit, another over 20 grand to cover the risk up there. And the reason for this, of course, is that we're short naked calls. That's what's causing this conundrum here. So what could we do? So do we leave the position like this? Well, we could. We could leave the position like this, and most likely nothing will happen, quote unquote, and it will just stay around here. But there are some ways that we could certainly tighten up this position. One thing, which would put a Band-Aid on this for a day. Remember, as options traders, a lot of times we are just trying to kind of sidestep having to make the big moves and just kind of like trade our way through stuff. So one thing we could do is we could buy some calls that expire in a day, right? So if we were to go out here, we could buy some of these 60 calls for 4 cents, right? So $4, and that might help our position. Well, let's see what would that do to our position. Well, let's pick a better call. Let's say we bought this call for 23 bucks, the 47 call. All right, so I'm going to click on that option, and then what it's going to do is it's going to add that to our position in the Analyze tab, and we'll see how that helps us. I'm going to pull it up here so we can see a little better. Let me get my big head out of the way again here. So this is the trade that I'm thinking about doing. Now I can unclick it and see how it changes things, then click it. So how is this changing things? Well, look, it cuts my loss in half for a 100% move. So, but this only lasts for tonight and tomorrow. It only lasts for a day. So is it worth it to cut my risk in half for a 100% move for a day to pay 23 bucks? Well, certainly if tomorrow this goes up 100%, it certainly would be. But that's something you have to decide. But that's an option right there, right? Now, instead of paying 22 bucks, what if we pick an option? And the way I can change this is I can just go up here and adjust the strike. What if I were to pick like the 60 call? Now I'm only paying four bucks, right? No big deal. What does that do if I pay 4 bucks? Well, it reduces my loss by like 1,500 bucks. So that's pretty cool. Now notice it doesn't do anything to my buying power. To affect my buying power, I would have to actually buy an option in the same expiration cycle as the ones I'm short. So if I were to switch the expiration till next week and I were to buy a call, well, all of a sudden, look how it changes my buying power. If you look over here in the corner, with the call, all right, my buying power went down by a lot. So this helps my buying power a lot to buy this option out here next week. If I were to buy the 60 call paying 79 cents, that would help my buying power a lot. What if I were to buy, two at the money calls? So right now we're trading 36.33. What if I were to buy the 2 of the 37 calls? All right, well, that would help my buying power hugely, right? It cuts it in half. Instead of, and look at how my losses decrease. For a 100% move now, if I buy 2 of these calls, all of a sudden my loss is only $700 for this move up, right? I'm still collecting $75 a day, but it totally helps my position. The only problem with this is how much is it going to cost me to buy these 2 calls? Well, it's going to cost me 800 bucks, right? So that would negate a lot of the profitability potential of this position, right? It would essentially cut the profitability potential in half. So, what do you want to do? My feeling with this position, there's tons of different things we could do here, but my feeling is that I would like to cut my risk by 1 naked call today, right? So currently this position, I am short 4 naked calls and 2 naked puts. If I were to reduce this by 1 call, just pick one of these. All right, it's going to reduce my buying power effect up 100% by a third, and it's going to reduce my losses by a decent amount too. So, I put these trades on. I've made $173 off this position already. So for me, it seems to make sense that I take the profit on that a little bit and I reduce my risk and I take at least one of these naked calls off. And let me show you some of them that I had in mind, and you tell me what you think of it. So, for example, all right, so most of the position is in this expiration here, the July 2. I'm short 2 of these, and I have this layout set up to show how many I'm short. So I'm short 2 of these 47 calls and 1 of the 60 calls, right? I sold these, 47 calls at 248, I think, if we go back and look. 240. I sold 1 at 247 and 1 at 248. So if I were to buy some lower strike for less than 248, then I would essentially, like in a vacuum, I would be locking in a free call spread, right? So if I sell one of these 47 calls at 247 and I buy a lower strike paying 247, then it's essentially a free shot, a free call spread. Another way of looking at this is, well, I'm short 2 of these 47 calls. If I were to buy some other option that costs less than 2 times the price of what I sold these for, so 247 times 2, about $5. If I were to buy some option less than, let's say, 490, then I'm net collecting money on this position, and I'm set up nicely with this 1/2 spread if things pop, right? So maybe I buy one of these 39 calls. Well, how would that affect my position? Well, let's model it. So we'll go under Analyze Trade, and we can look at our price slices again. So without this, I'm short 12 deltas. Let's reset this to 10%. With this, it's showing at 40, I make $36. With this, at 40, I make $200. My buying power would come in by, let's see, so without this call, my buying power is negative 9,775. With this call, my buying power goes down to negative 8,300. So brings in about 1,500 in buying power, essentially takes off part of the position. Another way of looking at this, okay, is if you're better with seeing stuff, and many guys are better at seeing stuff visually. So we can go under risk profile up here on the analyze, right? And you're going to see visually what the risk looks like. So let me try to pull this down to give us more space here. So this is going to show, all right, so right now we're 36 and change. This position breaks even. Break even today would be around 33.25 to the downside, and to the upside 46. So pretty decent range to break even here, right? But that is with the call. That is with buying the other call. So let's take out buying the other call. So I'm going to go down here and click the other call. So without doing anything, our break-even points is tighter to the upside. It's just below 41 to the upside, and to the downside it is 31. So it's the same to the downside, right? That makes sense because we're not affecting our downside by buying a call in. So without buying a call in, we start losing money after this goes above 41. With buying a call, we start losing money after this goes above what? $46 and change. So yeah, so these are the ways I kind of look at and analyze before I do some trades. I can look and see what's my break even, what's this doing to my position, what should I do? And like I said, for my particular level of risk, and I'm not saying that this is right or wrong, and the likelihood is that you have a different risk tolerance than I do. Maybe you have a bigger risk tolerance and like this position seems like no big deal the way it is, and you would just leave it. Maybe you think, oh, that's crazy. Why are you taking so much risk? This thing could, the market looks terrible. There's all kind of weird news going on. The VIX is elevated. This thing could spike at any minute, and you've got way too much risk on. I would never have that much risk on. But that is, how risk adverse you are is something that you're going to have to decide for yourself. But just some thoughts with a UVXY position. Tell me what you think about that in the comments below. Hey, Supernova, look at, thanks. That's very nice for all of, thank you very much for those super chats. That's very friendly of you. Biotechs are more moderate to trade in this environment. Follow the big money, the hedge fund money. What's the slow running ETF which tracks volatility? Well, I mean, I think that VXX is a slower running ETF, but even SVXY is half as levered as VXX is. So SVXY trades, it has half the risk of VXX and a quarter of the risk of course, TVIX, which is ending. So it really depends on how much risk you want. You see that little triangle up there in my display? That's part of the, I think that's something to do with the green screen or something. Something's reflecting off the green screen back there. Thank you, Supernova, for the super chats. That's awesome. So anyways, hope you guys get something out of this. Please leave any comments below. Please remember to cover your position in VXA, in TVIX. TVIX is getting delisted, so please cover your position. I'm sure you probably already know that if you're watching this video, as well as you guys, D-guys. People are asking me, well, all this conspiracy theory stuff, et cetera, et cetera. Look, just cover your position. Sell out if you're long it. Buy it in if you're short it before the second, and move on with your life. Getting cutesy with like you're going to leave it on after that is just going to get you into trouble, headaches, and problems. And it's going to be problems for me too, because people are going to call me and be like, whatever. Robinhood is a good broker, but sometimes the platform is down all day. Well, that happens with, every brokerage has its problems. Anti-God, I would suggest to everybody who's watching this that you have more than one brokerage on tap. I have a couple of them. That way, if something goes down, you just kind of pivot to another one. I know it's not convenient for people to have money in all different accounts everywhere, you don't necessarily have to do that, but you can open the account, and then if you need to transfer money, it takes a couple of days. At least the account's open and ready to go. I don't know. I like trading anti-God. My favorite product to trade with the VIX is probably VXX. It has the best liquidity and stuff. This particular lesson is on UVXY, but my favorite VIX product is VXX. I don't generally like to stay long the VIX. It's only rare occasions that I'm actually long. I'm generally more on the short side of things, and I generally trade options, but VXX is more liquid than this one, and it's not leveraged. This is a 1.5 times leverage fund, UVXY, and it's going to be more risky as we slowly move to the upside here in UVXY. So I think probably what I'm going to do by the end of the day is I'm going to buy one call. I kind of like the sound and the thought in my mind of buying some lower strike to cover one of these calls I'm short and turning it into a one free spread to the upside. I'm probably going to do something by the end of the day because I feel like I have just a little too much risk to the upside here. Thank you, Anti-God. And thank you, everybody else, for watching. I will see you next time on the Short Vol Show Live. Thanks for watching, everybody. And best of luck trading the rest of this week. Please be careful. I'm not advocating people sell naked options in VIX products. It's a risky proposition, and you need to know more about what you're doing before you just jump into this kind of thing. Everybody's risks vary, and thus I can't recommend stuff for you. I'm not licensed to recommend stuff for you. And you should take my trades just as an example of what one trader does and develop your own ideas and your own trading style, because the only way you're going to be successful is by developing your own ideas. Unfortunately, I know that sounds hard and everything, but that's just the way it is. Goodbye, Anti-God, and goodbye, everybody else. Ciao.
You're watching famous.
Vediamo dopo.